I started touching on interest rates and cap rates last week, and as developers, this is a massive area of focus for us, and we as a team spend a lot of time talking to various people in the industry in their areas of expertise, whether it's brokers, it's bankers, it's other developers, and we want to try and understand as much as we can what the general consensus is for where things are heading. I think that we have a general consensus that the Fed is likely to raise interest rates one more time. They just announced a quarter-point raise. We're likely to see one more quarter-point raise sometime as we're now headed into the second quarter of 2023. The general consensus is that there's not much higher that they can go, especially in light of what happened with SVB and Signature Bank. There's a couple other banks that are in that area where people are getting a little skittish. So as interest rates rise, you're starting to see the banks have a struggle to have liquid assets to give to their depositors when their depositors are taking money out of the bank. So you may recognize that interest rates climbed, inflation climbed, cost to the everyday consumer went up. Consumers started withholding more money and not leaving it in the bank, and that put pressure on the banks to come up with money to give back to the depositors. Well, as interest rates rose, banks had much of their money in treasuries, in secure assets, in bonds, things that they knew were going to give a safe return, but they bought them at a very low interest rate, and they had to sell those assets to make money for their depositors. And in selling those assets, they had to take a loss. When you buy those secure assets, there's a set amount of time you have to hold them before you can realize the full promised interest. The banks had to sell those assets off at a loss to fulfill their depositors. That put their balance sheet in check. And of course, once the run starts and once people start getting nervous, the banks get under serious pressure. So what we're feeling is, in a general consensus, is that the Fed cannot put too much more upward pressure on interest rates because they're continuing to expose the banks to this gap between what they're going to owe to their depositors and what they have to sell these assets for and taking a big loss. So what that means for us. Well, in 2022, self-storage assets, Class A assets, traded at an average of a 4.6 cap. But keep in mind, that average is for the year. And as I talk to brokers and other developers, the consensus is two things. Number one, most of the transactions happened early in 2022. There was a definite slowdown as we went into the later part of the year. So more transactions earlier, and according to the brokers, a definite change in what the cap rate was. So if you were to take the average for the first half of 2022 versus the average cap rate for the second half of 2022, you would have likely seen a higher cap rate average for the second half of the year. There is upward pressure on cap rates. Quickly understand, a 5 cap simply means that it's going to take you 20 years to recoup the money that you paid for that asset based on its net operating income, right? 100% of your investment would come back in 20 years. 100 divided by 20, that's a 5 cap. A 4 cap would represent 25 years. So you'd be paying a higher price. You'd be paying 5 extra years of net operating income. The consensus between bankers and brokers and other developers that we've talked to is we expect to see about a 100 basis point increase in the cap rates that these assets are going to trade at over the next couple years. Everyone figures we're pretty much at the peak of interest rates right now. To go to get a construction loan on a self-storage facility, it's going to cost us about 8% interest with a bank loan. Maybe that goes up by another 25 basis points to 8.25%. We expect another rise of about 100 basis points, so from 4.6 somewhere to the mid 5s, maybe up to 6 caps in secondary and tertiary markets in your really prime locations, your Miamis, your Bostons, your New Yorks, your LAs, those primary markets, still probably seeing cap rates in the sub 5s, but you have to put that into your math, into your underwriting as you're looking at these facilities, a little bit more conservative in what you're expecting you might be able to exit at. So I want to make sure that we're arming you with as much information as you can. So if you're underwriting a deal and you're looking at a deal, you cannot look through the same lens that you might have been looking at in 2020 or 2021. And what I hope for you, and certainly we're very lucky with our underwriting team, we put a bunch of deals under contract in 2020 and 2021 into 2022. And the reality is the situation now is very different. But because we underwrite conservatively and we left a bunch of meat on the bone of these deals, we are still in a great place with all of these projects. And what's fantastic for us is as interest rates are rising and as construction costs are rising and it's costing us more money to get these facilities to market, something else is rising too. What else is rising? The rates that people are paying for storage. So even though we might get hurt a little bit in the short term on our total cost to get these products to market, we know that in the long run, that asset is going to be worth more because storage rental rates are going up as well. Hey, if you felt you got some value out of this video, please hit that subscribe button, give me a like, give me a comment. I love nothing more than to hear you asking questions. I'm happy to give you answers. If I don't know the answer off the top of my head, I have a network that's more than happy to help me get you the right answer. So get involved, throw some comments in there. Throw comments in there on what you might like to hear more about. We are going to bring these videos to you weekly, sometimes even more than one a week. Subscribe to the channel so you get updates when we put new content out there. And if you're super interested in what we're doing, go to StorageSyndicate.com, find out all about our mastermind, and learn more about legacy developers.